Well, a down day in grain and livestock futures trade on Monday. Brian Grete with Pro Farmer is back with analysis. Well, the grain trade, let's talk about that first. It felt like a risk-off day. Some of that coming from weather and some of these rains in the eastern Corn Belt, Brian.
Yeah, just a complete washout, Michelle. So we had fundamental factors, the rains that you mentioned. Some of the drier areas in the southern and eastern Corn Belt got some decent rains last week, and then remnants of Hurricane Beryl are expected to bring more this week. And so that's a negative factor. Generally mild conditions from a temperature perspective. We will see some heat build later in the week and into next week, but nothing excessive by any means. And so the traders are looking at it as generally favorable conditions moving forward. You throw in pretty broad-based selling across the commodity sector today, and technical sell-off, and it just turned into a real ugly start to the week.
And very disheartening in the grains, considering we had some bullish weekly key reversals last week in the grains.
Yeah, so it's kind of interesting because we did have the holiday last Thursday, and then we had a full market day on Friday. Historically, the day after, right after the 4th of July, typically either accelerates the current trend or reverses it. And last Friday's price action suggested that maybe we would reverse out of it, but Monday's trade definitely, wiped all of that out and then some. And so here we are, and it looks like it will be an acceleration of the downtrend that we saw into the 4th of July.
So what is your thought? We talk about weather here and favorable weather in the central and eastern Corn Belt now, but you still have concerns about flooding in the west or the northwestern Corn Belt. And why is the market totally disregarded that?
Well, I think let's be realistic. USDA isn't going to change its yields on Friday in the report. So we're going to get the bigger acreage figure for corn. There's going to be no adjustment on the yield side of things, and that's going to give us a bigger production number. As we move into August, that's when we get our first estimate. So USDA starts to estimate the crop based on farmer surveys, satellite imagery, and other factors. So that's when some of that could come into play. The other factor is in August is the acreage stuff. So FSA acreage data will start to be incorporated. And so we'll start to see some of those acres that have been lost to the flooding, excessive moisture, hail, those types of things. It probably isn't going to lop off as much as what some hope it would. But instead of a 92% on the harvested acreage, maybe it creeps down to 91.5, 91%, something like that, and takes some off. But it's still going to be a big crop unless we have some sort of yield robbing factor weather-wise as we move through the growing season here.
So let's talk about the reports coming up on Friday. Obviously, you said USDA probably won't change yield. And when you add in the bigger corn acres, you add in the bigger stocks, quarterly stocks for all of the grains. What do you expect?
Well, we're going to see bigger ending stocks for corn on the old crop balance sheet. We're going to see bigger ending stocks on the new crop balance sheet. Now, some of that will be offset. Typically, 1 out of every 3 bushels that's added, they increase demand on. And so you don't see the full effect just on the supply side of things. You will get some more demand, but not enough. And we will see bigger ending stocks estimates for corn, both old crop and new crop.
And Brian, you mentioned earlier that really there's no reason for the funds or the speculative traders to buy in this market. Will the funds continue to push the short side? And how unusual is it for them to be this short at this part of the season?
Yeah, just all record short across the grain and soy markets at the moment cumulatively, and so very bearish. That probably should limit the downside, but if there's no reason for funds to be buyers, it doesn't mean that they're going to suddenly start covering short positions. And so while it may limit the downside risk from a short-term perspective, everything else tells them, the technicals, the lack of a weather threat, those types of things tell them to continue to be sellers, and they're just comfortable on the short side of the market. Until that comfort level changes and they want to cover some short positions, it's going to be really difficult for the corn and soybean and wheat markets to find traction and put in bottoms.
Wheat market has had a really tough go here. Obviously, we've retraced so much of the spring rally that we had, and the continued pressure that we're seeing now, is that because we are seeing some better yields or what?
Yeah, so strong yields here in the U.S. and USDA also provide us with the first all wheat crop estimate on Friday, and so that'll be the first survey-based numbers on other spring wheat in Durham, and so we'll get the first full wheat crop estimate. But seasonally, it's not the right time for wheat to lead and to the upside, and so when you get a day like we had on Monday with corn and soybeans trading sharply to the downside, wheat's going to be a follower. The other factor to come into play is that the Russian crop was under stress, and it still is to some degree. But crop estimates coming out of the Black Sea region are starting to creep up some, so that they went too low, it appears, and so that isn't helping the bullish cause by any means.
I also want to ask you about export inspections this morning. A little disappointing, especially considering we're at such low prices here in grains.
Yeah. So on the corn side of things, we continue to chunk down the weekly pace needed to reach USDA's forecast for 23-24. On the soybean side, we're slow, and that's seasonally we're slow, but we're even slower than what the seasonals would normally be. So we need to get a little bit of boost on the soybean side of things. We have a lot of competition, obviously, coming from South America. The Brazilian safrinha corn harvest is ripping along at a record pace, and so those supplies will be hitting the global market soon, and obviously they produced a lot of soybeans this year, and so there's a lot of competition for U.S. exports at the moment.
Cattle market, despite record cash, despite lower corn futures, today we ended lower. So, what was the problem? Why could we not follow the cash?
Well, they started trading to the upside. Live cattle posted modest gains early in the morning, and that dried up. The feeders traded sharply to the upside on the weakness in the corn market, and that dried up as well. And once they turned lower, it became a broad-based sell-off there, and part of that's tied to everything else that was going on within the commodity complex today. It's just a negative day, and the cattle market got caught up in that. Now the cash, you referenced that. 4 weeks in a row that we've seen record prices, and yet the futures are trading well below the cash market. That's pretty typical for something that happens when traders anticipate that we're close to a major top. And so after 4 weeks of record cash strength, I'm anticipating that it'll run out of steam here sometime, and as are the futures, and as are the traders. Where the futures are so far below the cash at the moment.
So, do you think that means that we will not be able to retest the record highs from last September?
I still think that we have another push probably to the upside unless something changes fundamentally in here. The domestic demand has been pretty strong. We've seen the wholesale beef prices absolutely on fire. The packers, despite paying record prices, their margins are in the black, and so that speaks to the strength of the wholesale market. The question is going to be how long and how resilient is the consumer, because retail prices are really high right now, and so far the consumer has stepped up. But will that remain the case? And we're also into a time frame now. After you get past the 4th of July, it's the summer doldrums for beef demand typically until you get to Labor Day, and then you get kind of a boost, and then you get another lull until you get some of the end of the year stuff. So we're into a weaker time frame for beef demand. So that will be an important factor moving forward.
Gotcha. The lean hog futures, has that market bottomed, or do we, have a tough time bottoming if the cash market is not bottoming?
Yeah, so the seasonal top in the hog market came in May this year. Typically, that would be sometime in June or even into July. Sometimes it stretches out into August, and came much earlier than normal. And now we're talking about the hog market trying to find a bottom when it seasonally should be topping. And from a seasonality standpoint, the numbers build pretty significantly as we go through the second half of the year. And so it's probably going to be a grind for the hog market. Probably not a whole lot of downside risk because of the what we've seen from a price perspective over the past month or two here, but also not much upside price potential.
Okay, thanks for joining us. Brian Grete with Pro Farmer, and that is Markets